Oh, hey, how's it going? Alexis Carrasco here with Real Home Sales. Today, I will be reporting what you need to know when you purchase a home, types of mortgages, interest rates, and when, ideally, would be the best time to make that purchase. If you've been considering buying a home in this beautiful state of ours, Colorado, then look no further because you're on the right track to making the best home purchasing decision ever. And today, rates are at an all-time low. If you'd like a 15-year fixed rate mortgage, you're looking at about 4.02%. Now, if you'd like to possibly have a longer term on your mortgage and have the payments a little bit smaller, your rate is looking at 4.58%, which is not bad at all, considering that the market fluctuates, rates could get lower, rates could get higher. So if you've been thinking, dreaming, oh, I want a home, I don't want to rent anymore, I want to build equity for myself, for my family, a better life, ultimately just to own that property under your name, and you've been wondering, man, when is the time to buy? The time is now. Now, when dealing with a type of loan, whether it be for a car, a home, or just for personal expenses, maybe a vacation, there's this theory that backs every single thing available in terms of investment or money available to loan is the loanable funds theory. Now, this theory is pretty much wrapped up with investors who, prior to being investors, were actually people just like you and I. Instead of spending, however, and consuming their money earned, they in hand decided to save it for purposes of loaning it out to other people, and in return they'll charge an interest rate to earn some money off of that. Now, these people who have saved up their money have been governments, maybe businesses, and this everything that goes hand to hand with the loanable funds theory ties in with supply and demand. Supply and demand, baby. You can never try to back out of this law. It's impossible. If there's enough supply and the demand's there, people will in hand borrow money because it could be cheap, the interest rate could be low. But when interest rates rise and it becomes more expensive to borrow money, that's when people think twice before, like, oh, I'll apply for a loan, because in hand it turns more expensive to buy a home. Now, moving from loanable funds theory into another factor that has a great influence on whether our mortgage rates go up or down is the federal funds rate. Now, believe it or not, which this actually surprised me as well, banks actually borrow money from each other. Maybe a Wells Fargo needs money from another Wells Fargo to meet its reserve requirements. So there's this new thing where if I were to deposit $100 into an account, now be with me, I know $100, blah blah blah, whatever, $100. Out of those $100, 10% needs, by law, has to go into a fund as a reserve. So if another financial crisis were to happen, money could in a sense be give out, and $90 from that 100, so 90% would then go and gets invested. They loan it out so they could earn money on that money. Money moves. Now with the federal funds rate, it's an overnight loan process which interest rates are relatively low and they're uncollateralized basis. But the thing is, based on some research, this rate is looking relatively low, 2%, 2.5%, not too high, which is a good sign, because that then indicates that we're on the right path and we're not going to see a recession and none of that anytime soon. Now, the last thing we need to worry about when deciding to make our home purchase would be whether treasury bonds are at a high or a low yield. As you guys are aware, the United States is in pretty deep in debt. What is it, almost $20 trillion? Now, in order for the United States to fund its debt and to fund its budget and just keep up to base, it sells yields, United States Treasury bonds, which are at a high yield by the United States Treasury Department. These are sold at an auction. Now, at an auction, there's a lot of bidders because investors know that this is an ultra safe way of getting some fixed rate of money back. Now, they sell them at face value with some interest, and if there's a bid war over the bond, the United States will still only pay its face value with the interest. Now, reason why it affects banks is because when the demand is high for the money, for the bonds, there's going to be a lower yield since the United States doesn't need to pay as much back. But when there's not enough demand and the United States really needs the money, that's when yields go up in order to attract investors. With a higher yield, better rate of return, baby, you're most likely going to take that option. Now, lenders and bank institutions see this as an opportunity to mess with 15 and 30-year mortgages on the length of their term. They don't take advantage of it. They just seize what's there. And if they see that interest rates could be higher for those mortgages, why not do it? I mean, we're the ones borrowing the money. At the end of the day, it sucks. But according to the Treasury bond statistics, yields are very low for either 3-month, 15-year, or 30-year Treasury bonds rate maturity. In closing, I hope you guys have realized that the United States is in a tremendous growth economically speaking. We're having construction everywhere. More and more jobs are being created here in the United States. And I encourage you guys, stop dreaming, take action. If you want to buy a home, the time is now, like I mentioned. So if you like, you could call me at 720-236-2010, and I will do my best to get you into your home.